Mendes is Managing Director and Head of Macro Strategy at Desjardins. He joins us here in studio. We could talk about the Thanksgiving parade. We could talk about interest rates. Interest rates a little less fun, but a little bit more important to the markets right now. And your view hasn't changed when it comes to the Bank of Canada heading into next year?
Our view hasn't changed, even despite the new Canadian mortgage charter. I think what that document really does is provide a little bit of a safety net for the borrowers that are in the worst shape, the ones that are really, really going to be stretched and be in major financial trouble. It puts a little bit of a safety net beneath them. It'll help in terms of renegotiating mortgages, extending amortizations, not having to pass the stress test again. But for the vast majority of mortgage holders, our thesis remains true, and that is that as we march forward in time, every month about 1% or 1.5% of mortgage holders are renewing their mortgage, and that means more money is being put towards debt service and less money is being put into the economy, spending on goods and services to create jobs for everyone. And as we head into the middle of 2024 and into 25 and 26, really the only thing that can help offset these mortgage payment shocks in any material way is a lower Bank of Canada policy rate. And
just you're sort of looking at a couple of years. That's because mortgage renewals, this is a process that's constantly taking place, and that I guess, are some people who are coming off of whatever, like a 5-year mortgage cycle that would have to renew and could have some sticker shock this year, next year, the year after, that kind of thing.
Yeah, so there are a number of mortgages that are coming up for renewal, and people will face payment shocks, but really the biggest pain will come in 25 and 26. That's when the people who took out mortgages in 2020 and 2021 will be renewing their 5-year mortgages, whether they're fixed rate or variable rate, the latter of which will be people who will be seeing very significant payment shocks, as much as almost 70%, according to our simulations. And what that really shows you is that while I think it's become almost a consensus call now that the Canadian economy at least falls into a mild recession in 2024, what we see is that the stagnation in the economy will likely persist into 2025 and possibly into 2026, assuming that nothing materially changes on the front of mortgage renewals, like the federal government or other governments don't unveil some major plans to change the dynamic of these mortgage renewals, slowing the economy.
And then walk us through again your thinking on what happens with rates, because some people, and I'm not going to say this consensus, but it's becoming pretty popular on Bay Street for people to say they wouldn't be surprised to see if, let's say, the Bank of Canada were to cut interest rates moving into the second half of next year. But you're talking about a timeline that I believe, come to the end or into the second quarter, that could actually be a reality for the bank.
Yeah, I think the bank could start cutting as early as the second quarter, as long as two conditions are met. One is that headline inflation is at or below 3%. And the second being that the unemployment rate is around 6.5%. So clearly there's some slack in the economy. The reason the Bank of Canada can start thinking about cutting interest rates when headline inflation is still at 3% and not their 2% target is because they're forward-looking. And so much of what's driving inflation right now are these shelter costs, which higher interest rates are actually pushing up those shelter costs, not doing anything to bring them down. So that's the reason we have penciled in rate cuts beginning a little bit earlier. You're right, though. I think it's become consensus that, the Bank of Canada is going to be cutting rates next year. Where we still stand apart from other forecasters and from the market implied path for the Bank of Canada's policy rate is in 2025 and 2026, where we believe the bank will have to ease policy to about 2.5% and leave it there so that the monetary officials can offset some of the pain of these higher mortgage payment shocks. Not all of the pain. People will still see positive and materially positive payment shocks, but just some of the pain, so that we're not in a recession for longer than is necessary to bring inflation under control.
People should make note of that projection, because that would be quite a sharp reversal in where interest rates are right now. You mentioned borrowing costs being one of the inflationary factors in the short term, and we saw that in the most recent inflation data. I want to bring back the latest commentary from the Bank of Canada itself, or from Tiff Macklem, who was speaking with his own outlook this week, and as I alluded to, said that he feels like he's seeing some pretty good progress on cooling pricing based on the restrictive policy we've seen put in place. And yet you still have that caveat that is thrown into most commentary, which is essentially we reserve the right to stay hawkish, to keep rates higher, to raise rates if we need to. What is the intent there? What's the point of that messaging?
Well, that's guarding against an unforeseen pickup in inflation. So inflation has been coming down. We've moved from above 8% now to just above 3%. I think the next little bit, we'll probably see it hang around 3% in the months to come. But if there were a situation where inflation started to pick up, let's say from a global energy shock, the Bank of Canada could move off of the sidelines and raise rates again. They're saying that to Canadians. However, I think that is becoming more and more of a tail risk rather than a real risk that should be accounted for in terms of the likely outlook for policy over the next few months.
Before I let you go, since this is Canada's day to shine in the North American market dynamics, are we set up for a slightly different story on both the economy and central bank policy heading into next year? Because you just keep hearing things about, yeah, maybe the Fed's done with rate hikes, but a resilient U.S. economy. You don't hear as much about the resilience here just because of these issues like the mortgage story.
Yeah, I think it's rare that Canada goes its own way, but these are unique risks to Canada because of its mortgage market and because of how much household debt Canadians hold on their shoulders. So I think you could see monetary policy start to diverge next year. Not that the Fed won't cut rates, but the Fed will probably need to cut rates by less because they don't have the same 5-year mortgage cycle. Most of the people with mortgages in the U.S. have very long-term, 15 or the most common fixed term is actually a 30-year mortgage. Those people are protected from higher interest rates in this environment. So, thinking about the difference between Canadians and Americans, Canadians are facing the prospect of higher interest rates affecting their lives much sooner than Americans would be.
Okay.